Time now for business. We say hello to Kate Moody.
Hi, Francois.
On top of doing booming business during this pandemic, Amazon's just won in the courts. It doesn't have to pay the 250 million euros in back taxes over its reported earnings in Luxembourg.
Yeah, absolutely. This is the ruling coming down from the EU's second highest court, which has ruled against a European Commission decision to seek that 250 million euros in back taxes from the tech giant. In 2017, Brussels had found that Amazon was given special tax treatment that amounted to illegal state aid in Luxembourg. This decision could still be appealed to the European Court of Justice, as Luke Schrago reports.
Amazon won't have to pay Luxembourg 250 million euros in back taxes. That's after the EU's General Court ruled that the EU Commission hadn't proven to the requisite legal standard there was an undue reduction of the tax burden of a European subsidiary of the Amazon Group. The case dated back to 2017, with the EU's official in charge of antitrust issues, Margrethe Vestager, seeking to clamp down on tax deals that amount to state aid. She accused Amazon of benefiting from an arrangement with Luxembourg, where its European operations are headquartered, one allowing it to avoid paying taxes on 3/4 of its earnings in the bloc. It's something Vestager has targeted for years, and she's forced Belgium, Ireland, Luxembourg and the Netherlands to change their practices of offering sweetheart tax deals to attract firms to their territory. However, pushing companies to shoulder their tax burdens proven harder, with a similar case against Apple going in the tech giant's favour last year. For experts, existing rules mean prosecutors' hands are often tied.
We need to take the current corporate tax system and throw it in the bin. The transfer pricing rules have completely failed. And there are negotiations going on looking at updating the corporate tax system, but unfortunately governments are not ambitious enough. We need a complete reform because these rules are clearly outdated.
That may be closer than previously thought. Washington recently embraced the idea of an international minimum tax on multinationals, with the Organization for Economic Cooperation and Development saying the world had never been so close to a deal on the issue.
In a separate case at the European General Court, the French energy giant Engie lost its appeal on a similar ruling about its tax arrangements in Luxembourg. It may now have to pay 120 million euros in back taxes. Inflation in the United States soared to its highest level in over a decade in April. The Consumer Price Index jumped 4.2% compared to a year earlier. That's the fastest pace since 2008. Prices rose 0.8% compared to the previous month. It is the second consecutive month of high inflation. The Federal Reserve has said it will not raise interest rates or reduce its monthly bond purchases in a move to try and calm inflation because it believes the numbers will settle closer to its 2% target within the coming months. Some economists, though, have warned that when combined with the $1.9 trillion stimulus package, the high inflation is an indication the American economy could be overheating. Well, that inflation data piled more pressure on Wall Street. After taking a breather on Tuesday, the tech-heavy Nasdaq has tumbled another 2%. The Dow Jones down over 400 points this hour as it continues a slide that saw its worst session since February. The major European indices managed to rebound earlier as strong corporate results lifted trade. Shares of drugs giant Bayer and German lender Commerzbank up 7% and 8% respectively. Energy stocks rose as well as oil prices continued to rise on strong demand and that ongoing risk of shortages in the U.S. linked to a cyber attack on a pipeline. The UK and EU have each issued upbeat data about their economies. The British economy contracted 1.5% in the first 3 months of the year, despite being in a strict lockdown, and actually managed to grow more than 2% in March. The Bank of England expects GDP to rebound by at least 7% this year. Meanwhile, the European Commission has upgraded its forecast for recovery. After a slump of more than 6% last year, the bloc is set to grow over 4% this year and next. France will see stronger growth this year and around average next year. Europe's largest economy, Germany, had seen a milder recession in 2020, so its recovery is expected to be more muted. Spain, meanwhile, which saw the biggest percentage slump last year, is on track to grow just under 6% in 2021.
For a year, we have been presenting forecasts that were very negative. Today, for the first time since the pandemic hit, we see some optimism prevailing over uncertainty. That uncertainty is, of course, still there, and we should never forget this. But recovery is no longer a mirage. It is underway.
There you go. Nice to have some positive news to end on.
All right. Many thanks for that, Kate Moody. We'll have more business news for you later.